Hello, welcome to Chapter 7, Inventory and Cost of Goods Sold. Some of the key learning objectives for this chapter are: describe the issues in managing different types of inventory, explain how to report inventory and cost of goods sold, and frequently refer cost of goods sold, refer to it as CGS. Calculate cost using 4 different inventory costing methods or assumptions. Report inventory at the lower of cost or market net realizable value. So that's the accounting principle that we're going to look at. And finally, another new financial ratio, this time is the inventory turnover rate. Alright, let's start with our first learning objective, issues in managing different types of inventory. For almost any type of business, managing inventory is very important. You would say, especially for businesses such as manufacturing or retailers, merchandisers, to a pure service sector of the industry may be less important. But if you look at a manufacturing company, a retail company, then the primary goals are threefold. First, we're going to look at the quantity, and second, quality, and in the meantime, cost of inventory. So we need to have sufficient amount of quantity of inventory to meet customers' needs. When you have customers at your store, and that's an opportunity for you to make sales, you of course would love to have enough quantity of inventory on hand to satisfy that need. Quality, of course, is very important. Quality is directly related to customer satisfaction and expectation and your company's own quality control standards. If anything, if customer not happy, they're going to return, they're going to give the stuff back to you, and they're not going to be happy, so they're going to tell other people they're not going to come back, so that's bad. And finally, the cost of acquiring and carrying the inventory. Remember the concept we introduced in Chapter 6, that's the cost of inventory, including not only the cost of acquiring the inventory, but also the cost of carrying the inventory, including transportation cost and storage, warehousing cost. Alright, different type of inventory very quickly. This is not the focus of this chapter, but if we compare the 2 types of businesses that I just mentioned, manufacturers versus merchandisers, in terms of inventory management, merchandisers are quote-unquote easier because they are in the business of purchasing finished goods and then sell those finished goods, of course, hopefully with a markup. So for example, in our examples, we have seen that Walmart purchased children's bicycles and then sells those same bicycles at a higher price to its end customers. That's the business model that Walmart is in. Manufacturers, on the other hand, are more complicated because they buy raw materials and then produce or convert the raw materials into finished goods and then sell those finished goods. So for example, if we think Ford or General Motors as car manufacturers, they purchase raw materials. Could be steel, rubber, glass, paint, and then they convert those raw materials, plastic, into finished cars and trucks, and then sell those cars and trucks to customers. They don't sell the raw materials, the steel, aluminum, glass, wire, plastic to customers. So their inventory is more complicated because they have raw materials in the inventory. they also have finished goods in the inventory, but they also have work in process, or WIP, in between, between the raw material of aluminum, steel, rubber, glass, and the finished cars. There are many steps. There are many different parts. So those could be partially completed products, could be parts for the cars. Those are included in the category of WIP, or work in process. All right, our next learning objective is about how to report inventory and CGI and CGS, cost of goods sold. So here we have a script of the balance sheet of American Eagle Outfitters. We look at their current asset. Under assets, they have inventory, 2 years of inventory for the fiscal year ended in 2016 versus 2017. And then we can also look at their income statement. They have net sales minus cost of goods sold equals gross profit. So inventory is reported on the balance sheet as a current asset, and cost of goods sold is reported on the income statement as an expense. We have learned those in chapter 6, in the previous chapter. In chapter 6, we also look at periodic inventory system or method and the perpetual method. Under the periodic method, we said beginning inventory plus purchase minus ending inventory equals cost of goods sold. That's how we can figure out. That's kind of the only way under the periodic method we can figure out what's the CGS. Because at the end of the period, we do an inventory counting, and then we decide the value or the cost of the ending inventory, and then we can figure out what is the CGS. So the second part, decide the cost of the ending inventory, is the core or the focus of the current chapter, chapter 7. Under the perpetual system, we have the beginning inventory plus purchase minus cost of goods sold equals ending inventory. Remember, we said we use this ending inventory to compare with a physical count of the ending inventory to do what? To identify potential shrinkage. So here, we actually have the same challenge. That is, even if we have recorded the quantity of cost of goods sold. Remember, under the perpetual system, we constantly updating the inventory. We take into consideration any purchase, return, and sales of inventory. So it's easy to record the quantity of the goods that we have sold. But the same challenge remains on how to decide the cost of goods sold. Okay, so that's a very quick review of chapter 6. Let's look at one example. So a company has a beginning inventory for the period of 5 units that cost $10 each, and then purchase 20 units with a cost of 10 each. Sells 15 units and is left with 10 units in the ending inventory. All right, so under the periodic system, we know the cost of the beginning inventory is 5 units times 10 each equals 50. Purchase is 20 units times 10 each, that's 200. And then total available inventory is 50 plus 200, 250. The ending inventory, again, it's a periodic system. So the ending inventory is 10 units at $10 each, $100. So the cost of goods sold is $150. For a perpetual system, we have the same information. So the total cost of the beginning inventory is $50. Purchase is $200. So total available is $250. Cost of goods sold is $150. So the ending inventory should have a cost of $100. However, we really hope that real life is as simple as in this case. I mean, this case is good because it illustrates how do we use the periodic system and the perpetual system. However, there is a very important assumption that's applied here. I think I will give everyone 10 seconds to try to figure out what the assumption is. Or you can pause and to think about it. So basically the assumption is unit cost remains the same. That is, for the beginning inventory and all the purchases we made and all the stuff that we sold, we assume that the unit cost remained the same at $10 each. The same thing for the perpetual inventory, which, as we know, most likely is not going to be the case. For example, if you drive a car and if you say have to get gasoline, of course, from the gas station, say once a week, and then how many times have you ever experienced that for the whole year? Every time you go to the gas station, the price is exactly the same. The price stayed unchanged, let's say $2.49? No, there's always some fluctuation. So if we do have fluctuation, that's why things get a little bit complicated, and that's why we're going to look at the different inventory cost methods or assumptions, as we're going to see why we call it assumptions. So we're going to look at 4 methods: specific identification, FIFO or first in, first out, last in, first out, LIFO, and weighted average. Among the 4 methods, only the 3, the FIFO, the LIFO, and the weighted average, require calculation. Alright, so inventory costing method, the first one, let's look at specific identification. The assumptions for the 4 methods are here the same. So let's assume that on the 4 days, 3rd, 5th, 6th, and 8th, those 4 things happened. We purchased 1 unit for $70, purchased another for $75, purchased one more for $95. So obviously the price is, keeping going up. And then we sold two units for $125 each. So we of course have a simplified case here that we don't have beginning inventory, but eventually we can treat beginning inventory as part of the inventory available for sale. So don't worry about that. So here the challenge is you have 3 units that's available for sale. 1, 2, and 3. But you sold 2 units. So how do we know which 2 out of 3 were sold and which one is left? Of course, the 2 questions eventually come down to the same one. That is, as long as you know which 2 was sold, the 3rd one must be the one that's left, which is an important lesson because what? Ending inventory plus the cost of goods sold equals available inventory, which equals beginning inventory plus purchases. So as long as you know one of the 2, ending inventory and cost of goods sold, you most likely will be able to figure the other one out. Alright, I will have to stop here, and I'm going to pick up on the specific identification method and the other methods in my next clip.